Some interesting detail there, and certainly just imagine being able to purchase property around the $250,000, odd thousand mark, that close to the city. I imagine if it was an investment, you might be in cash flow positive territory as well. So pretty exciting stuff, I think. Joining me on the show now is Tony Romano. He is a financier with the ANZ Bank. And Tony, good to have you back.
Tim, thanks for the invite. It's good to be back.
Yeah, good to see you. Tony, why don't we go over a little bit of an update on some of the things that we've talked about in the past.
Sure.
But perhaps let's start with how the finance sector is at the moment. And obviously we know we've had a 0.5% reduction in the cash rate. How are things travelling at the moment?
Yeah, look, the official cash rate's gone down to 3.75%, so that means that borrowers are able to access money at cheaper costs. I mean, eventually that'll transcend into lower variable rates and fixed rates. So, you know, banks are sort of geared up to borrow money. I guess looking at the finance industry holistically, there's a lot of issues in Europe at the moment, Greece in particular. So at the moment, there's a lot of uncertainty about equity markets, and we're seeing that with you know, the Australian share market being hit and overseas markets being hit. So there's a number of opportunities that a lot of people need to take advantage of, I suppose, and we were talking about it earlier on. And it's in relation to superannuation, for example. So, yes. I mean, in relation to, probably a lot of people know about the co-contribution, which is basically the government putting in an equivalent amount into superannuation that you lodge. Yep. So, you know, the amount is $1,000. So if you put $1,000 in after-tax dollars into your own superannuation fund, yep, the government will put in another $1,000 if your income is between $31,920 or up to $61,920. So that's going to be reduced next year, right, to $500, and also the income threshold will come down to $41,920. So for people who've got superannuation, it's an absolute must that you do that before the end of June. Yes. So that's one area. 5 weeks to go. Yeah, that's not far away. So in other areas, for example, is in relation to golden handshakes. A lot of people may be considering redundancies as well, and you know, maybe using those funds for property or for lifestyle needs. The tax concessions will be lessened in the next financial year. So if you're thinking about redundancy, I'd be taking it this financial year rather than next financial year. It's
interesting you say that because perhaps a little bit of detail on that. You mentioned a fairly significant amount of money as an example. If someone was, say, taking a redundancy payout that might be, just for example, $200,000. Sure. If they took it this year and invested it, as opposed to next year, what's the likely saving in doing it this year?
Sure, they'll be about $30,000 better off.
On 200,000,
exactly, which is a lot of money. Exactly. So, because of the higher tax rate applicable next year, it's going to eat into that capital, and so therefore they'll be left with less money. So, if you're going to do it, I'll be considering it this financial year. So that's on that side in the finance market. But there's, as I said, a lot of opportunities in relation to self-managed super funds. We've covered off on that previously. Yeah.
Episode 66 it was.
Episode 66,
if people want some reference back to some specific detail on that.
Yep, and a lot of people are, you know, there's probably 450,000 superannuation funds, I suppose, in the self-managed area. Self-managed superannuation is growing at an astronomical rate at the moment, and obviously that gives you the opportunity to control the assets you put in there. Yep. So there's a lot of requirement around the borrowing within the fund to buy property, for example. People like to have assets in there that they can buy and see and touch and feel. Yes. And with interest rates coming down as well, and you mentioned $250,000, $260,000, yields are starting to look attractive on property. So if I was I'm a landlord, I mean, the yields are starting to look attractive. So the rent I'm making on those properties with a lower price base is giving me a yield equivalent or above term deposit rates, or even the yield on dividends in shares, which are the alternative to my property. So
what, just to talk about some of those figures, what obviously when you talk about yield on property, a couple of years ago we might have been talking 3-4%. Correct. Now we might be up 4-5-6%.
That's right, because the capital base is lower.
Is lower, and the rents have gone up a little over the last couple of years as well. But if we talk interest rates and we talk return on other investments, interest rates you can lock in obviously, but they're lower. What's happening with the fixed term interest rates at the moment? Are they coming back a bit as well?
The yield curve, which is the direction where interest rates are heading, is sloping downwards, which means the longer you're going out, the more likely rates are going to be lower. So people who are looking to lock away, maybe for a short term, might still get 5.5%, for example. That rate will come down. The Reserve Bank, who changed the rate, I think, on the 12th of May last, are looking now at reducing rates further. So it might come down another 75 basis points or another 100 basis points, which is another 0.75 or 1% on that 3.75, which will mean the funding cost will go down, but that will mean that our deposit rates will go down as well. So when people are looking to lock away, they're going to lock away with a lesser amount of money. And if it's in term deposit, there's no capital growth either. So inflation, which is obviously the prices are still rising. We're noticing, like, electricity and all our utilities are going up as well.
Yes.
Yep, and you need to cater for that inflation. And this is where the capital growth in property is so important, because that's what gives you the hedge against inflation. So growth assets are a critical part of any portfolio of assets that you have.
Okay, and the super funds where you might have a great reliance on property trusts and shares and so forth. Having come back off a little bit, the increased yield on property becomes a little bit more significant and more enjoyable. We touched on the idea of people liking to own something that might have some benefit for them in the future. Whether it be a beach house or an apartment in the city that they might retire to or something like that. How are those sorts of situations moving forward? Because I know when I thought that it was a little bit dodgy to be involved in something like that, but you have corrected me. So
yeah, look, it was a taboo subject with a lot of people. It's called, people who have assets in their superannuation fund are not supposed to use them for personal use. So generally people have shied away from buying that investment property. So if someone wanted to retire, let's say in Victor Harbour or Port Elliot or in the city, for example, and you thought, okay, well, I'll buy it for 10 years, 20 years down the track, but I'll buy it in my superannuation fund because I've got cash sitting in my superannuation fund. What they can do is rent it out in the meantime, but they can still have it as their retirement place in the future, because what they will do is they will then transfer that asset when they're able to access their superannuation as a pension into their own name. So all the while, 10, 15, 20 years they've kept it in their superannuation fund, it will be free of any capital gains tax. So if they bought it for $500,000, it's worth $1 million 20 years down the track, for example, and the rate properties grow, that's probably not an unrealistic expectation where it doubles. There will be no capital gains tax on that $500,000 gain they've made. They'll transfer the property out as a benefit payment if they want, as a lump sum payment, and they'll then be able to use it in their own use as they require.
So that absolute two distinct ownership and uses for the same property as time goes by.
Correct.
What about if we transferred it out before retirement?
If you transfer it out before retirement, it would have to go to another superannuation fund. So the only way you can transfer money outside of a superannuation fund is you've met the condition of release. All right. Look, Tony,
there's a lot more to talk about, and if you're happy to stay with us, we'll do that. And now we're going to go and have a look at our Going, Going, Gone segment.